Welcome to the Stateless Standard. Sit back and listen as we go beyond the old ideas of donkeys and elephants. Unlocking the truth behind the banking system. 5 secrets about money that banks don't want you to know. Money makes the world go round, and banks are the backbone of any economy. But have you ever wondered how the banking system really works? What if I told you that banks have been keeping a few secrets from us, and these hidden truths could potentially change the way we perceive money and the financial world? Brace yourself, because in this article, we'll uncover 5 truths about money that banks don't want you to know. 1. Keeping your money in a bank is a scam. Yes, you heard that right. We have been conditioned to believe that depositing our money into a bank is the safest and most responsible thing to do with our savings. After all, we expect to earn interest on our deposits, right? But take a closer look at the numbers, and you'll see that this is far from the truth. The top banks offer a measly interest rate of less than 0.5%. This means that while your money sits in the bank, it's barely growing. In fact, inflation is outpacing the interest rate offered by banks, so the value of your money is actually decreasing over time. Moreover, during times of inflation, asset prices like homes and stocks rise exponentially while your money in the bank remains stagnant. This means that keeping your money in a bank is not only a waste of potential earnings, but it also diminishes your purchasing power over time. Moreover, during times of inflation, asset prices like homes and stocks rise exponentially while your money in the bank remains stagnant. This means that keeping your money in a bank is not only a waste of potential earnings, but it also diminishes your purchasing power over time. 1. Banks have the right to create money out of thin air. You might think that only the Federal Reserve has the power to create money out of thin air. But did you know that every bank has a similar ability? This concept is known as fractional reserve banking, where banks are allowed to create money based on how much has been deposited by customers. Let's say you deposit $1,000 into a bank. They are only required to keep 10% of that amount and can lend out the rest to other customers. This means that for every $1,000 deposited, the bank can create an additional $900 out of thin air. In essence, banks are creating money every time they lend out customers' deposits, and they have been doing this for centuries. It's a profitable business model for them, but it comes with its own set of risks. In essence, banks are creating money every time they lend out customers' deposits, and they have been doing this for centuries. It's a profitable business model for them, but it comes with its own set of risks. 1. You can make money by borrowing from banks. You might be wondering how you can make money by borrowing from banks when you have to pay back the loan amount with interest. The key here is to take advantage of interest rates. When interest rates are lower than the inflation rate, it means that borrowing money is essentially free. This is why even billionaires like Mark Zuckerberg opt for mortgages instead of paying cash for their properties. For example, imagine borrowing $1 million at an interest rate of 1%. If you invest that money in a savings account with an average rate of return of 2.4%, you would earn $24,000 a year. Your monthly mortgage payments would only amount to $10,500, which means you'll still make a profit of over $10,000 every year. This concept works best with large sums of money, and it's how the wealthy use debt to their advantage. 1. The rich get lower interest rates. It's not surprising that banks prefer lending money to the wealthy. After all, they have assets and income streams that can act as collateral in case they default on their loans. For example, if a billionaire fails to make their mortgage payments, they can easily sell a portion of their business or assets to pay it off. On the other hand, for an average employee who may not have many assets or a stable income, the risk of them defaulting on a loan is higher, and banks don't like to take risks, especially when it comes to their profits. This is why the richer you are, the lower the interest rate you receive from banks. 1. Cryptocurrencies could change the banking system. Since the emergence of cryptocurrencies, traditional banks have been wary of their potential to disrupt the banking system. Cryptocurrencies operate on a decentralized network, which means they are not controlled by any central authority or banking institution. This means that anyone can create their own cryptocurrency, and theoretically, anyone can start a bank and create money without any regulations. Cryptocurrencies have gained significant momentum in recent years, with some even becoming billionaires overnight. If this trend continues, it could pose a threat to the traditional banking system and its power over creating and controlling money. The banking system has been around for centuries, and it has evolved to become one of the most powerful institutions in the world. But as with any system, there are always secrets and hidden truths that are not meant to be known by the general public. With these secrets now out in the open, it's up to us to educate ourselves and make informed decisions about our money and how we choose to use it. Who knows? With this knowledge, you might even be able to outsmart the banks and make them work in your favor. Thank you for listening. Please give us a thumbs up, it really helps us out. We'd also appreciate if you subscribed and told your friends too.